heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, OpenAI's historic funding round. We discuss one of the largest ever private investments and its new loan agreement, securing $10 billion in total liquidity.
And AI dominates VC deals. We have the latest data for venture funding in the third quarter.
And Nvidia insiders cash in on the AI hype, selling $1.8 billion of shares this year alone. That and so much more coming up, Ed.
Yeah, straight to our top story. OpenAI said it has completed a deal to raise $6.6 billion in new funding, giving the AI company a $157 billion valuation and bolstering its efforts to build the world's leading generative AI technology. In the last hour, the startups also announced a $4 billion credit line from banks around the world, giving it access to a more than $10 billion war chest. Bloomberg's Rachel Metz joins us on set in San Francisco, and we've been tracking this for weeks and months, and it's finally done. But the important point is they need the money because the cutting-edge model requires the money to train and build.
Yes, they are in a very expensive business. If you want to build a cutting-edge large language model, any kind of cutting-edge AI model at this point, you're looking at potentially spending up to hundreds of millions of dollars. So if you think about multiplying that out over a couple of $1 billion, I mean, it's like, well, you can train a couple models there. What if you train one and you're like, you know what, I'm not that happy with this? I mean, it costs a lot of money. Also, they need, chips. They have staff. They have all kinds of expenses there. They are bringing in revenue, of course, but it still costs quite a bit to do what they're doing.
It is the future revenue growth, the future profitability that means standout names from VC like Thrive Capital, like Khosla Ventures back the round, but numerous big, substantial banks back the credit facility. We're looking at Goldman Sachs, JP Morgan, Santander, Wells Fargo, to name but a few. What is the future growth model that they're all building a $157 billion valuation on, Rachel?
I mean, they're looking at businesses using their products going forward. They're hoping that businesses will increasingly do things like fine-tune the models. They recently made it so that businesses can do that and use them in different parts of their workflow and find it useful enough that they will keep paying for it. And they are starting to see uptake. They have quite a number of both individual and business users at this point. They recently passed the 1 million business user mark for business users of ChatGPT in particular. But they still have a long ways to go if they want to get to this level that this valuation is showing them going to at some point.
There's 2 points I want to make really quick with my sort of finance coverage hat on. This is a pre-EBITDA private company or a pre-positive EBITDA private company, so that it could go to banks and get $4 billion in credit is remarkable. And also the eagle-eyed audience will say some of those banks are in Europe. That is also remarkable. Rachel, when they announced the closing of the equity round, they also gave us data on how they're doing, not necessarily financial metrics, but like how many people are using OpenAI? Do we know anything about like the scale of this company in the real world?
Yes, we do. We know that there are, I think it's 250 million weekly users of ChatGPT. As we previously reported, they also recently passed more than 1 million business users for ChatGPT, and that spans a couple different products related both to an educational product. They have a smaller business product, like for smaller companies, and then also like a larger, more enterprisey product. So they're definitely trying to hit at a lot of different people in a lot of different areas, and they are doing it. They are certainly bringing in revenue, and they are seeing users. I think what remains to be seen is how well this will all work over time. What kind of, investors have to be willing to wait. They have to be very patient, right? This is not like your average startup where it's like, well, you might get a short-term return, and then maybe you'll get a long-term return. This is like, well, you're going to have to wait and see what we come up with over time.
Rachel Metz, we thank you so much. Meanwhile, Khosla Ventures participated in the OpenAI round, as we mentioned. Tune in tomorrow, our interview with Vinod Khosla on this and, of course, AI's future impact. Now we turn to another key story. US prosecutors are broadening a probe of potential price fixing by German software maker SAP and tech reseller Carahsoft, seeking to examine the company's work with almost 100 government agencies, according to a new court record. Bloomberg's Jake Bleiberg is here with more. You've been sifting through these court documents. Remind us what is being investigated, if not accused quite yet.
Absolutely. The investigation is looking at the companies you mentioned, SAP, Carahsoft, and then some other companies, the identities of which we don't all know, for a potential scheme, and I should stress that it's potential, not proven, to fix the prices, to inflate the prices in sales of SAP technology to the US government.
Jake, you joined us the other day to discuss your original reporting. What I'm trying to do is understand what's new here. 100 agencies is more than the agencies you outlined the other day, so that's new. But is there an expansion in the scope of what they're looking at? Have they discovered more information that prompted more agencies to say, we better get on board with this?
Absolutely. It's difficult to say what the prosecutors have discovered at this point. And something we do know is that they say they've been having difficulty getting information from the company sort of at the heart of this, Carahsoft. But as you point to, what has happened is they went from an investigation primarily focused on sales to the Department of Defense, and then just as of July, broadened this out pretty dramatically to look at sales to 94, or as many as 94 civilian government agencies as well.
We're looking now at the statements coming from the companies. SAP saying it follows the rules around disclosing legal risks, and based on the current circumstances, there was and still no requirement to report on the individual cases. Carahsoft also gave us a statement. But ultimately, how are they going to be interacting with these hundreds of agencies? What role do they now play in this?
It's a great question. The sort of historic role that both of these companies have played is by putting out a product. SAP makes all sorts of workforce software, time cards, HR software, and the complicated process of selling that sort of software to the US government is sort of handled by Carahsoft, which stands in the middle and does a lot of the difficult work of helping the software manufacturer navigate these regulatory hurdles. So what those relationships will look like going forward in the middle of this investigation is a big open question.
Bloomberg's Jake Bleiberg, who broke the original story and continues across the developing story. Thank you very much. Now, coming up here on the show, is job displacement caused by AI something to brace for, or is this just all hype? We discussed with MIT economist Darren Acemoglu, who gives us his more skeptical view on what's really happening with AI and the jobs market. This is Bloomberg Technology.
SoftBank founder Masayoshi Son has sketched out one of the most aggressive timelines for the adoption of AI yet, envisioning a near future where the technology would run entire households, from monitoring the health of family members to grocery shopping. Now, in a speech at an annual forum for enterprise clients earlier today, Son said that artificial general intelligence, or AGI, would arrive within the next 2 to 3 years. Ed.
But not everyone is so bullish on AI, at least not when it comes to jobs. Darren Acemoglu, a renowned professor at MIT, says that by his calculation, only a small percent of all jobs, around 5%, is right to be taken over, or at least heavily aided by AI over the next decade. Darren Acemoglu joins us now, and welcome to the program. This was one of the most read stories on Bloomberg in the last 24 hours. There's no surprise about that. It has all of the facets of a story that would, just engage our audience on Bloomberg Technology. Let's get specifics. Why only 5% of jobs, and which sectors and industries are you basing your thesis on?
Well, thanks, Ed. It's great to be on the program. I think right now, there is a lot of potential, excitement, perhaps hype about AI. But if you look at its current capabilities, we are very far from AI, either generative AI or other types of AI, performing any of the tasks that involve a heavy level of interaction with the physical world. Construction work, manufacturing work, carpentry. Those perhaps one day will be much more feasible, for example, if AI becomes so much more advanced, so much more reliable, and can be integrated with so much better robots, for instance. But it's not something that's going to happen in the next 5 or 10 years. Now, there's a lot of other potential for future AI, perhaps to perform some social tasks. But those are not going to be possible right now either. You're not going to go to an AI psychiatrist anytime soon. So if you strip out all of these, you're not going to be left with much more than 5% of the economy.
Professor, may I jump in and push back with a point raised by our audience when I said you were coming on, which is that AI technology is exponential, much in the way that the invention of electricity with time led to all sorts of breakthroughs. Right now, you're saying 5% of jobs, but in 2 years or 5 years from now, would you need to rethink your thesis or redo your calculations?
I should have prefaced this by saying there's a huge amount of uncertainty in any forecasts about AI, and apologies that I didn't do that. I try to do that all the time. I was very excited. I just jumped into it. There's a huge amount of uncertainty, and one source of uncertainty is exactly what's going to happen with AI in the next several years. I don't think that the most optimistic views in the industry, which sometimes people refer to as scaling laws, actually will hold water when you look at it within the next 5 years or 10 years, which say, just double the amount of data, double the amount of compute power, and then you're going to get double the amount of capabilities. Because to do that, we would actually need higher quality data. So if you want AI to do the job of a carpenter, you really need a completely different kettle of fish when it comes to the kinds of data. And something like that might be feasible with a different architecture of AI, but right now all of the money is going into the sort of the basic dominant architecture, which has its limitations both in terms of reliability, in terms of high-level reasoning. So that's the basis of my belief that, of course, generative AI and other types of AI will improve, but we're not going to see a qualitative jump within the next 5 to 10 years.
Professor, your belief, what is exactly it based on? What data, what historical norms are you looking back on to drive and push forward on this 5% take?
Yeah, I think this is why there is so much uncertainty. There's nothing that's identical to generative AI in the past, and that's part of the reason why people can hold very different beliefs. But what I'm basing that on is, first of all, other waves of digital technologies that promised a lot of automation, sometimes a lot of productivity improvements, sometimes a lot of changes in the way that we would organize our offices and things like that. And at the end, all of those changes have been very gradual. And also what we have seen over the last 2.5 years where, there have been advances, but the advances haven't really been sort of qualitative in nature. They haven't really exceeded the sort of the basic capabilities of GPT 3.5 or GPT-4. So there will be advances, but I don't think any of those advances will very quickly change the way that we do various tasks in the economy. So, for example, I do not believe that in 5 years' time, when we look at the labor market, we're going to see certain occupations that will have completely disappeared.
But many would say, Professor, that they would be augmented. The idea is perhaps the optimist view is we will not lose lots of people from the labor force, but their productivity will be scaled.
Yes.
No, please.
I think that's a very, very interesting and important point. I am not an AI denier or an AI pessimist. I actually believe AI has a lot of potential. And in fact, the real potential is exactly what you said, Caroline, which is that AI becomes a tool for workers to boost their productivity. And again, we're seeing some of that happening. Microsoft has a lot of co-pilots, some of them work, and they give some productivity improvements. There are a few areas where we're seeing really phenomenal improvements. Like, for example, if you want to write simple subroutines in one of the common programming languages, GPT-4 is great. Before then, GitHub Copilot was pretty good. So there are some things in which that sort of help to decision makers is possible. But again, when you look at the whole economy, that means helping carpenters, electricians, plumbers, blue-collar workers, construction workers, transport workers, people who are doing teaching, people who are doing journalism. Those are things that could be achieved perhaps at some point, but the reliability and the reasoning of the models is not up to the task yet.
Do you see specific job creation in specific industries from AI?
Well, there is one class of jobs where AI is leading a big boost, which is people who have AI fluency, either people who are AI programmers, AI integrators, or other AI-related service activities. But in my research, albeit from a previous wave of AI in the late 2010s, we didn't see any other job category get a boost in terms of hiring.
Right.
And there are some other jobs that I think there will be some retrenchment. So if you're in IT security and you're doing sort of routine end of IT security, there will be declines in job vacancies in that area because some of these AI tools can actually perform that quite well.
When you see the headline that OpenAI is worth $157 billion, when you see that Nvidia is now worth almost $3 trillion, what do you make of that in terms of how truly the capital markets are analyzing the growth here?
Well, I think there's a difference between Nvidia and OpenAI. Nvidia is riding a wave which is based on the belief that those chips are going to become more valuable because generative AI and other types of AI are going to continue to boom, but they are generating revenues. OpenAI, on the other hand, I think hasn't found a revenue model that could justify the types of valuations we are seeing at the moment. Now, it may well be that in the future, suddenly their API is going to be so valuable and other firms are going to start building on it, but it doesn't seem like there are the kinds of applications that can have deep impact on the productivity of workers or the automation of firms that are going to be sold within the next 5 years, 10 years. So I'm a little bit skeptical, but on the other hand, OpenAI is also emerging as the market leader, and the current ecosystem in the digital world is firms that take over the market, and they can use all of the data, they can, interact with the consumers or the programmers directly. Those have become very valuable because of venture capital or other deep-pocketed funders.
Can't wait to see the response to this interview. I'm sure Sam Altman has some thoughts. MIT economics professor Daron Acemoglu, we appreciate your time. Oura has just rolled out a new flagship device with the Ring 4, updating its popular smart rings with new sensors, better battery life, and a better algorithm. This is competition is really heating up. Samsung, of course, debuting its own Galaxy Ring. For more, Oura CEO Tom Hale joins us. So how does this make you distinct from the crowd?
Well, the thing about the Oura Ring 4 is that it's slimmer, sleeker, thinner, better, of course, and the feel of the ring is what matters to many people because there's a lot of technology packed in here. You want it to be small and compact. Maybe more importantly, we've taken a big leap forward in sensing with something we call smart sensing. And smart sensing adjusts dynamically to your body because not everyone's the same. Your anatomy is not the same, your physiology is not the same, your skin color is not the same, and we adjust dynamically. Even as you rotate the ring a little bit, we actually are able to keep the most accurate signal.
Tom, who do you consider to be the competition for this ring? Is it other rings? Or is it other form factors of device? I think a lot about watches at the moment, particularly having just been at Apple's event in recent weeks.
What's interesting to me is that amongst our users, almost 2/3 wear a second wearable, usually a smartwatch. The smartwatch, great for daytime notifications, you're getting alerts all the time, but has an Achilles heel, which is battery life. And the ring is something that doesn't, ask for your attention, doesn't send you notifications. It's just in the background, seamlessly fitting into your life, capturing your physiology so that you don't have to pay a ton of attention to it. And as a result, you have an 8-day battery life with the OR4 ring. And so what that's really interesting to think about is that you just don't have to worry about your health as much. And then therefore, the watch and the ring can be compatible. So in many ways, like, we find these things to be two devices that can work together on one person's body.
And what's interesting is you've been working with other companies that make other devices. We understand from Mark Gurman's reporting that you've been working alongside Meta's Ray-Ban team, for example. How do you see integration with other businesses going?
Well, we've got so many great partners that we work with. We haven't announced anything formally with Meta, but you can imagine this world where you have this cloud of devices on your body that you're using in different contexts. Maybe it's headphones, maybe it's glasses with an AI assistant. And how does your physiological state and something that you've got on your body all the time work maybe as a controller, maybe as a way to guide, maybe as a way to provide input, maybe as a way to give your other wearables a sense of whether you're stressed or whether you're well rested or whether you're ready. There's a lot of really interesting opportunities to explore when you think about a permanently worn device that's oriented around your health, that's on your body 24/7.
Tom, we've just shown your latest financials and the trajectory of this company. Your focus this point has been technology and innovation, but where do you see this company going from here, the direction for the business?
Yeah, I mean, I think there's a lot of headroom for us to grow just simply in the ring category. Rings are new. People are just learning about the benefits of long-term health tracking, learning about the benefits of getting sleep, learning about the understanding of their body. So, the way the ring works is it can tell you when you're getting sick. It can tell you when you're doing well. It gives you lots of information and lots of insights, even an AI coach that helps you make behavior changes. And I think there's a lot of headroom just in that category. Right. But as you look beyond that, not only is it interaction with other devices, but it might be potentially other devices that you might see. Like, we've seen prototypes for a locket that sits on your chest. We've seen prototypes for things that look more like designer rings. We introduced a product with Gucci a couple of years back, where we have something that looks much more like jewelry and much more like, much less like a piece of technology, and it really fits into your life. So I think the future is very bright for rings. Lots of headroom for us to grow this business. But more importantly, I think people being aware of their health and understanding how to manage their health is just a really big opportunity. Everybody on the planet should have one of these things.
Tom Hale, Oura CEO, good to catch up. Thank you.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. If you're just joining us this fine Thursday morning or waking up to financial markets as a technology investor, this is what it looks like. NASDAQ 100's kind of flat. There's a modest outperformance in semiconductors with a modest gain on the stocks. Bitcoin's kind of been under pressure throughout the US morning session. If you're an investor, it's been about weighing an escalating conflict in the Middle East with some economic data, a lot of hype around AI, but no strong movement in either direction, apart from a few single names. One of them is Nvidia. In an interview last night, Jensen Huang, the CEO, saying that demand for Blackwell, the latest GPU, is insane. No direct correlation, but the stock at one point trading at its highest level since August. Then EVgo, on track for its biggest jump since 2021, trading its highest level, I think, since May of 2023. It secured a $1.1 billion loan from the Department of Energy. Those are two kind of movers, a lot going on. But Nvidia in particular, on a daily basis, it's still the name that people are talking about, Kara.
Because it's worth more than $3 trillion when you're looking at its market capitalization. And look, insiders, they've been cashing in on what is a huge valuation jump. They've actually sold what is worth more than $1.8 billion in shares so far this year. Well, the selling, is it expected? Jess Menton is here to put this into context. We often see insiders sell shares, and it feels a lot when the market cap's up so much.
That's right. And this is in focus, and this is a really great story from Jaron Wittenstein and Carmen Reinecke on our equities team that put this together. And whenever this happens, people want to question a company whether or not there's growth concerns and things like that. But Jensen, of course, the CEO, this was pre-planned. And so when he actually went through and did this from mid-June until mid of last month, that actually correlated with obviously the drawdown drawdown that we saw with the stock because there was such a huge run up. I mean, it's still up close to like 150% year to date, but of course it's still down from that June peak around 9%, and still the S&P 500 has been able to rally even without one of the biggest weightings. But at a certain point, it actually eclipsed Microsoft and Apple in that market capitalization. But moving forward, there's actually supposed to be additional sales. So Nvidia's director is still supposed to sell about 3 million additional shares. So that's kind of a question mark of whether or not will we still continue to see the stock held back a little bit, even though we've seen it rally and come back from some of those lows that we saw earlier this summer, or will that keep those gains in check? But of course, I was talking to y'all about this yesterday, but Evercore actually made a call for chip makers and is more optimistic that we would see a rebound in the fourth quarter of this year.
So Jess, for so many people watching Bloomberg Technology, it will be a familiar story. It is a classic in Silicon Valley. Wealth creation from stock compensation. You sell shares over time. You get more money than you could ever have dreamed of. But there is a paragraph in the story that raises the question of whether or not the sales inspire confidence in the stock. Do they inspire confidence or not?
Well, there's someone, too, that when it comes to portfolio managers that the reporters were speaking with, and Ken Mahoney was actually one of them from Mahoney Asset Management. And he was talking about sometimes you shouldn't read too much into it. Say, for instance, Jensen was already pre-planned, but a lot of times it's not just because of reasons of growth concerns about the company. Obviously, you were just mentioning earlier, Ed, about how the CEO was talking about this insane demand for the Blackwell chips. Of course, there was a lot of scrutiny in recent weeks because obviously investors want the valuation of the company to justify those future earnings and the growth, but still those executive directors in the company, they sold about 11 million shares so far in 2024. And so to put that into context, that's the most since 2020, when you are excluding, of course, different stock splits like earlier this year and in 2021. But you do have some portfolio managers arguing it's not just because of growth concerns, Ed.
Bloomberg's Jess Menton. Brilliant as always. Thank you very much. Now, it's launch day for the Roundhill China Dragon ETF. It tracks an equal-weighted basket of Chinese tech companies under the ticker DRAG. Bloomberg's Isabel Lee had a story that hit the wire on the website in the last couple of hours. What's the idea behind this ETF?
So this tracks a basket that Roundhill made. So it's 5 to 10 Chinese companies that they qualified as those that exhibit great economies of scale, competitive advantages, and really basically companies that they believe in. So there are 5 to 10 stocks, and for now there are 9. These includes PDD, Alibaba, Meituan, BYD, NetEase. And what sets this apart from the other ETFs out there that track Chinese-linked stocks is that it's more targeted. We have the biggest iShares one, it tracks some 30. We have K-Web Crane shares, it tracks some 30 or 50. So this is just 5 to 10. And that's what they say. You don't want those little companies diluting your China exposure.
These are mega cap tech names in particular, Isabel. And the timing is kind of beautiful. It comes in line with everyone getting overexcited and a FOMO feel around Chinese stocks. Was it always planned to come out now?
That's the thing with ETFs. They filed earlier this year. You don't really know when it will come out. So they said that the timing couldn't have been better. But then they said they also really just make products when they see investor demand. And that actually is what caught my attention, because even if we all hear these kind of negative rhetoric around China, there are still investors who want China. Remember, there are two ways to look at China. It's too cheap, so let's buy it, or it's too cheap, so let's kind of stay away. And it's proving that the former is still kind of, that they're echo calls are kind of loud, because for Roundhill to launch an ETF like this just really showcases the demand of clients. But for now, it's trading today, and it's really interesting. It's also cheaper than some of its peers. It's only at 59 basis points.
I guess it's also for us like an interesting data set. Here on the show, we often look at the NASDAQ Golden Dragon Index as like a barometer of sentiment towards China tech. How unique is this ETF in the kind of landscape of products? Were they first? Are there more to come?
It's unique in the sense that it's Roundhill's selection. For now, there are only 9. They're only going to limit it to 5 to 10, and they can drop stocks that they think doesn't show economies of scale or solid fundamentals or competitive advantages. So that is kind of very interesting, because if you look at the Bloomberg Magnificent 7 index, it only really tracks those Magnificent 7 stocks. The NASDAQ 100 tracks all the big tech stocks. So to an extent, some investors really just want those targeted focus. You don't want this broad-based index. You just want this little slice of the market.
Bloomberg's Isabel Lee, thanks for bringing it to us. Coming up, where is the venture money going? Funnily enough, you could probably guess, given the OpenAI news. We've got the latest data with the PitchBook analyst, Carl Stanford. And we also dig into it all with a VC. Dina Shekhar, this is Bloomberg. Poolside is a startup building AI software for programmers. They've just raised $500 million from investors ahead of the company's plans to release an initial product. Now, the round was led by Bain Capital Ventures and includes funds from DST Global, Stepstone Group, Citi Ventures, and HSBC Ventures. Poolside said in a statement yesterday. Now, as Bloomberg reported last month, the new financing gives the startup valuation of $3 billion. Ed.
Venture deal-making hobbled along at a slightly better pace than a year ago in dollar terms, but investors are getting more selective and cash went to just a handful of companies. OpenAI's latest fundraising bodes more of the same to come for the current quarter and beyond. Let's bring in Carl Stanford from PitchBook, who's been crunching that data. And I point out from the offset that the data to date does not include that OpenAI round. We can get to it, but summarize the PitchBook data as of third quarter.
Right, it does not include that OpenAI deal, but what we've seen is that venture still continues to be a really slow market. When you look at exits and you look at fundraising, you can really see why that is. There's nothing coming out of the market right now. And so in the U.S. during Q3, there's about $37.5 billion invested, which is lower than the quarter before, but that had a few large deals. But there's nothing really exciting happening outside of AI in terms of investments being made right now.
Where is the excitement happening in AI from a geographical perspective, Carl?
Right, it's happening in San Francisco, it's happening here in the US, right? If you look at OpenAI, I think the deal that just closed shows two things. One, it shows the incredible amount of capital that AI needs and the cost that these companies are incurring. And it also shows the excitement around AI and the technology, right? If you look at who is in that, Nvidia, Microsoft, Thrive Capital, SoftBank, all these investors are looking at this deal and this company as something that's going to be able to provide them huge returns moving down the road, right? And that's how many of these investors have looked at AI, up and down the venture life cycle. And so that has definitely been the area of interest for investors, in the U.S. and globally up to this point.
So if we go on the basis that the data we're showing on the screen as of September 30th does not include the OpenAI round, how does it change the trajectory for 2024 against prior years when we do take that round into account?
Yeah, right. I mean, I think we can look at it and say, yeah, and obviously is going to make 2024 look much better. But if it's only one deal, it's not really capital available for the entire market. And I think that's something we've been saying with past quarters rounds of CoreWeave or Anthropic. These are very exciting, interesting, scaling companies. But that's not what the rest of the market is seeing, right? Valuations in AI are 40% higher than in other verticals. Deal sizes are much larger. Obviously, $6.6 billion is not a typical deal that many of these companies should expect anytime soon or ever. And so when you talk about the trajectory of the dollars going into the U.S. or the global venture market, I think that really needs to be taken into account.
What unplugs for the rest? If you're not AI native, but you're AI adopting and you've got a decent run rate in terms of revenue, do we need more exits to be able to see the money come back in?
Yeah, right. I mean, exits are still the kind of dam of the venture activity. And when we look at distributions that are coming out of the market, we know that there has been very, very little for the past 2 years. Even the IPOs of Q1 and Q2 we're not able to sustain the venture market. And so when you take how large the AUM has grown for VC in the past few years, then just consider that all of that is stuck private and LPs have no way to use that cash for more investments or to recycle it back into venture. You can really start to see why there's such a slow market over the past few quarters and something we should expect for the coming quarters as well.
Carl Stanford, PitchBook lead VC research analyst. We thank you. Let's get some more analysis from the horse's mouth, someone who's in VC. Lux Capital general partner Dina Shekhar joins us now. Dina, does that feel what you're seeing, a tale of two halves right now?
You know, it is in many ways a tale of two cities, but I don't think I would agree with the sentence that there's nothing exciting outside of AI. And at Lux, we love to invest in the intersections. In fact, we just had our AI Summit here in New York on Tuesday. And what you see is a lot of AI, but AI intersecting with life sciences, intersecting with physical intelligence, intersecting with health tech, even with Medicaid care delivery. So while I do think AI is very exciting, it's an area we've been investing in for quite some time, it's not necessarily the only area that we're seeing exciting investments these days.
That was the point when you launched a new fund, right? I remember all the things that I get excited about: robotics, dare I say it, life sciences. But has it been an easy environment to cut checks in? Because you sometimes have to find willing partners who have the same level of excitement that you do in those fields.
Yes, these are all areas we are still excited in, and I think one way in which it's a tale of two cities is that you're seeing these seasoned operators who are on their second or third company who may be building in AI or outside of AI that are getting these very large mega rounds, and then other companies that are struggling to raise those early dollars. That being said, we have companies across different stages and sectors that are continuing to raise. I think the big question, which Kyle pointed out, is really what the exit market looks like. And as we sat here 2 years ago, Caroline, talking about 2023 being the year, 2024 should be the year. I think we're all looking to 2025 to be the year where we start to see more of those exits and distributions.
Do you get that question and that pressure from the LPs for there to be exit opportunities?
You know, we are a deep tech fund, so we've always had long life cycles. We invest, what we like to invest in the impossible and turn it into the inevitable. And so we have patient LPs who know that these companies take time, and we look for the generational large companies that turn into very big outcomes.
Did any of those LPs want you to be in the OpenAI round?
Well, we'll see.
Well, what's interesting is some of the nuances around that round. People are sitting up and seeing who's leading it, but they're also sitting up and saying, oh, they're not allowed to invest in competitors. Is that usual, actually? When you invest in like a runway, which you're in, would ultimately you not go out and reallocate to a competitor in that space?
I would say that is normal, but not every fund approaches that the same way. From our perspective, we certainly don't intentionally invest in competitive companies. We like to put our resources, our connections, our network behind our investments. Oftentimes, companies will evolve over time and eventually end up intersecting, and that can certainly happen. But we do try to be careful to put our eggs in a basket and really double down on our winners.
There's something you mentioned a moment ago, Dina, that I think is probably true of whether you're in deep tech or in AI, in industrials or otherwise, which is the type of investor coming in is different. You see the very large mutual funds being a player, or Nvidia comes in as like a strategic. You're a sizable venture firm, but is it difficult for you to get in on some rounds because of those new types of player?
You know, our current fund is over $1 billion. We're investing in everything from incubation through pre-IPO. And so we have that ability to construct a portfolio across different stages. The job of any good VC, of course, is to buy low and sell high. And so we're able to do that across the spectrum of these companies. Where we believe there's still a massive outcome, even investing at a later stage, we will do that, and we have the ability to do that. And we also have the ability to start companies ourselves. Companies in our portfolio like Evolutionary Scale, which is applying AI to life sciences that we were early into, or A-Life Health, which we were the first institutional capital in, applying AI to the fertility space.
What about the companies that aren't, as we say, AI natives? You say there's a lot of excitement in the areas of intersection, but how are some of the other companies in the older portfolios able to cope with this current environment? Are they steering well? Are they managing to ensure that they're cutting costs and dialing in on revenue growth?
Absolutely, and it's those two things, well, three things I would say. One, AI is a way of doing things. It's not AI for AI's sake. So hopefully it's enabling efficiency, it's enabling better accuracy, it's enabling, better profit margins. And so every company needs to have an answer to that, not because it's what they need for fundraising, although it likely is, but also because it's what they need to survive in the world. This is a huge paradigm shift. It's a seismic shift. So all of our companies are doing that. And some of the most exciting applications I've seen are actually in companies that are very much still human-oriented, companies like Waymark in our portfolio, which is leveraging community health workers to deliver health care in Medicaid communities, but are using AI to help predict emergency room admissions and to help streamline the operations of healthcare providers.
Dina, you've been busy. You're always a busy person, but you've also become an author. Lena Mo's CEO. Very quickly, tell me about it.
Yes, Lena Mo, CEO, brand new book, just released last week. It's a story about a young girl who builds a robot to help shovel snow outside of her house, goes through the process of building a team, raising money, and was inspired by my own journey as a parent trying to explain venture capital to a bunch of preschoolers, which, as it turns out, is just as hard as explaining to fully grown adults.
You know, founders are getting younger, but that young, I don't know. Lux Capital General Partner Dina Shaker, thank you very much.
Today's big take, how global supply chains are the latest concern in the Ukraine-Russia war, as US-designed chips are finding their way inside Russia-made missiles. For more, Bloomberg's Stephanie Baker, who joins us now, she's also the author of a new book, Punishing Putin, Inside the Global Economic War to Bring Down Russia. Stephanie, you always tell stories with such depth and humanity. It's a difficult story to read, to be honest. But what we bring to our audience now is the intricacies of what chips made by who are finding their way into certain Russian missiles.
Right. So if you remember, after the invasion, the U.S. joined with its European allies and imposed sweeping export controls on Russia to deny the Russian military access to Western semiconductors and other technology. And they tightened those restrictions again starting last year. And there had been various reports about, citing trade data about components getting through, semiconductors getting through to Russia. What we wanted to do was really drill down and go do a deep dive on one missile attack where Ukrainian investigators had documented Western components by specific companies, and as well as examining their entire database. And what we came up with was that there's one company whose components keep getting found and are most frequently found on the battlefield, and that is Analog Devices. And we wanted to sort of put a human face on what was a sort of trade data story to show that actually Russia is very dependent on Western technology to guide its missile attacks on Ukraine.
Stephanie, what was the response from Analog? And also, I suppose, from the United States to the reporting?
Right. Well, Analog says they regard this as an illicit diversion of their products, and they do not condone any of this trade. And what we tried to get into in the story was explaining the complex supply chain for semiconductors, that there's a lot of production happening in Southeast Asia. There are a lot of middlemen acting, particularly through Hong Kong, using shell companies to do this trade. So it's been very hard to crack down. This is not Analog selling directly to Russia. And the U.S. has tried to enforce these export controls through the Commerce Department. That has proven difficult just because of the global nature of the supply chain and the many layers that semiconductors get traded through before actually reaching Russia.
Bloomberg's Stephanie Baker, who's in London. And as a reminder, the big take is titled Russian Missiles, American Chips. Find it on the Bloomberg terminal. Find it on Bloomberg.com. It is a must-read with detailed reporting, Caroline.
It is. Meanwhile, it's been detailed throughout. That does it for this edition of Bloomberg Technology. A lot of news when it comes to the private markets, the debt markets, the public markets as well, Ed.
Yeah, probably a historic day. We'll find out on that big OpenAI round. Recap all the reporting on the podcast. You know where to find it, on the Bloomberg terminal, as well as online on Apple, Spotify, and iHeart. Big shout out to the team in New York City and everyone here in San Francisco. This is Bloomberg Technology.